Hello and welcome back. My name is Austin if you're new here, and I'm a certified financial planner practitioner. On this channel we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. Today we're going to be talking about asset allocation and why it's so important. To give you a brief definition, asset allocation aims to balance risk and reward by choosing investments that are aligned with your goals, your risk tolerance, and your investment horizon. Asset allocation typically means a balance of stocks and bonds or other types of investments. For purposes of this video, we're going to talk about stocks and bonds mostly. Now, stocks tend to have more risk, but also more reward, while bonds have less risk and less reward potential. So your mixture of stocks and bonds in your investment portfolio will have everything to do with the risk and return potential of your investments. So it's important to consider these three things when we're talking about the right asset allocation. Number one is your goals. If somebody has a goal to retire in 30 years, you would invest your portfolio a lot differently than someone who's retiring in 1 year. If I have 30 years of time on my side, then I'm much more willing to be risky and to allow time for my money to grow. That might mean I'm 70 or 80 or 90, maybe 100% in stocks because I have 30 years. Someone who's a year from retirement and might need to start taking distributions from those funds and needs that money there, they might consider being far less aggressive and have far less money in stocks, depending on your situation. Number two, your risk tolerance. If you put two investors side by side who are both retiring in, let's say, 10 years, one investor may choose to be 80% in stock, which is more risky, and the other investor may choose to be 50% in stock, which is a little less risky. There's not a right or wrong answer there. You just have two investors who think differently about risk. There's bound to be a couple of market corrections potentially, or economic situations that cause market fluctuations. And if the portfolio goes down by 10 or 20 or more percent, one investor might get a little bit more nervous about that type of situation. So again, there's no right or wrong answer there. It's more aligning your investment portfolio with the risk that you're comfortable with. And number three is your investment horizon. If I'm investing, if I have money that I need for a home purchase next year, it wouldn't be wise for me to have that in, let's say, 100% stock. If I need money in a year from now and something happens in 6 months and the market drops by 30%, all of a sudden I don't have that down payment for my home anymore. Same thing is true with a goal that's 15, 20 years away. If you need money in 20 years, you can afford to be a little bit more risky with that money if you choose. So it's important to understand what your investment horizon is and to align your asset allocation appropriately. So to review, the three things to consider when choosing an asset allocation are your goals, your risk tolerance, and your time horizon. There's not a right or wrong answer to how it should be done. Everybody is different and everybody is unique. There are common principles and strategies to follow on how much stocks and bonds you should include or other types of investments in your portfolio. But these are the things you want to consider when you're determining an appropriate asset allocation. All right, thanks for watching. If you have questions about what you've learned, click the link in the description to learn more about our firm and how we can help. Thanks.